Welcome to Benny and the Squirrel, episode 69. It's a fun day here in July. We got my buddy David Dredge coming live from Singapore, and we got the Squirrel. How are we doing over there, Dave?
It's hot and steamy. It is hot and steamy.
Hi, Dave.
Yeah.
Hello, Rupert. Good to see you, mate.
All right. Well, let's get going. There's a lot going on right now. It's a good time to have you on. I figured we'd just start off, your recent note, and everybody who doesn't read Dave, you go to Convex Strategies, and he puts on a really excellent monthly note. So rest in peace to forward guidance, something you and I have talked about a lot. Why don't you talk a little about that with our new Fed chair?
Listen, we all have our hopes up as high as they could possibly be that Kevin Warsh will do what he says he's going to do. And he started off red hot by going and telling people he's not going to tell them anymore how he wants them to price markets. He's going to let them price markets and then interpret the information he can take from that. I mean, what a revolution in thought. I quoted Hayek in that note saying the exact same thing, 50 years ago. Nobody, only God knows what the fair price is. So just leave it to the market. And then that becomes the ultimate tool of communication and information. So more power to you, Chairman Warsh. Keep going. Don't give up.
And I heard that you have a buddy who's on the inflation committee. Maybe you got a little Dredge like seeping into inflation policy. Is that right?
Yeah, my good friend and just absolute stellar mentor, Bill White, the former BIS economist, who's written all the best stuff that's been written for the last 30 years and has been ignored by everybody. And somehow Mr. Warsh thinks he's worth listening to. So he's put him on the inflation frameworks task force, which I note in the article, the best thing about getting Bill's name out there is maybe people will, go through the effort of clicking on Google and going to Bill's website or the BIS's websites or all sort of economic journals and reading all the stuff he's been writing for 4 decades and get a different perspective than what they've been spoon-fed by the neo-Keynesian crowd their whole lives. And Bill's just a phenomenal guy and very, openly sees the world as a complex adaptive system, which obviously it is, and is the most humble guy. I quoted him years ago. He did an interview with our mutual friend, Danielle DiMartino Booth, that was on YouTube, and I quoted him from it. And he just tells the story that when he started at the Bank of Canada, they tried to target the currency, and then he moved to the Bank of England. They tried to target inflation, and he figured out eventually that they had the wrong model. They had just the wrong model. They had a model that assumed equilibrium, held everything constant as you turned one thing, and then programmed in assumptions that would define how the model behaved, none of which reflect empirical reality. And the right way to think about it is it's too complicated. And so you need to understand initial conditions and understand where you are and respond to the market, not try to predict and control the market. So hopeful.
Okay, so in terms of sort of the obvious sort of next iteration of forward guidance going, presumably we got to see a meaningful uplift in Treasury volatility.
Well, logically, I think what Chair Warsh, or those of us, who advocate this, natural volatility reduces tails, right? So you create thin tails, wider distributions, but thinner tails instead of tight, narrow distributions.
Yeah.
Suppress volatility with massively fat tails that everybody's, incentivized to ignore. And so what you've come through is this period, we talked about it last time with my inflation dots from the Bank of England, that you had this, unprecedented period of artificially suppressed volatility of CPI year-on-year changes that was manipulated. And now that we've released that manipulation, you can see the chaos that it's causing all over the world. And what you're saying is you want there to be natural volatility, naturally occurring forest fires, reduce the fire risk in the forest. And so you reduce the tail risk of the devastating, all-engulfing fire. And so I think what Kevin would be saying, what he would like to see is naturally occurring volatility that reduces the tail risk of, having to go from zero Fed funds rate to 5.5% in a year.
Yeah.
Okay. So you suppress that. So you've got naturally rising natural volatility in treasury markets. What happens to the basis trade market, right? And then but the corollary of that is what happens to government funding models in the absence of the basis trade market?
Yeah. So this is exactly right. So you've created a whole bunch of fat tail risk because of past policy practices, right? So you suppressed volatility, you suppressed interest rates, you created this totally nonsensical regulatory construction where the sort of combination of how banks are regulated and how insurance companies are regulated now necessitates hedge funds on massive leverage to sit in between the basis disconnect between cash markets and derivative markets. And they end up using a ton of leverage, and now you have to protect that by making sure there's low volatility. And the way the hedge fund and the banks are measuring the risk is based upon volatility, things like value at risk. And so they can apply a ton of leverage because the volatility is low, but that obviously creates a ton of tail risk. And so you end up in March 2020 and in Liberation Day, where the central bank has to keep intervening to bail out that leverage. So you want that to go away. So if you allow natural volatility, hopefully not blowing up the existing tails, then the amount of leverage that can be applied to that has to go down, and it reduces the risk in the system. So this, I believe, is what he wants to try to do. We talked about this, I think, last time. Trump, in essence, is a series of controlled burns. So Trump has come in and said, listen, the accumulated imbalances and risks in the system, government debt, trade imbalances, all these things are too big and too dangerous. There's too much accumulated dry brush in the forest. We need to clean some of it out. And so in the forest fire world, you do controlled burns. But it's always dangerous doing a controlled burn when too much risk has been built up, because any one of them can get out of control, which I'll argue is what leads to the infamous taco. Every time it starts to impact the bond market, he has to back away. That the extreme tariffs have to get cut back down again. The bombing has to get a ceasefire because the bond world is so fragile, you can't let it go. I said this the other day, maybe I said it to you, Ben. The fragility of the bond market has been the equity market's best friend for 15 years. Right?
Absolutely.
Because they can't let it go, and so they always intervene. The biggest risk in the system is zero risk-weighted assets. Everybody knows that. What caused the GFC? Zero risk-weighted assets. You had to bail out everything, and that proliferation of liquidity to keep that supported blows up equity prices and housing prices and commodity prices and whatever. And that just goes on and on. I think Chair Warsh would like to try to back away from that cycle.
Okay, so how easy is that going to be?
Probably not easy. Probably not easy. So I suspect you might get a little more volatility in the front end of interest rates, but maybe not so much so in the back end. I think they'll probably still be very cautious about the back end.
How do they pull that off?
Probably coordinating, as has been the case going back to the previous Treasury Secretary and her partner in the game, the former Fed chairman, still Fed governor, one of the oddest things I've ever seen. You reduce long end issuance, and they just keep doing it. And at least for now, the Fed, as we know, is buying front end to maintain stable reserves, ample reserves. I suspect, based on his long history of comments, that Chair Warsh is not a fan of the ongoing balance sheet expansion, but I'm not sure exactly. Obviously there's a balance sheet task force as well. Oddly, that one doesn't have anybody on it that is a technical balance sheet expert. So I found that one a little weird. There is one balance sheet expert, but he's on a different task force. So, but I think it's something they're going to have to tread lightly on. I think the premise is very good, but it's the old, Irish joke. How do you get to Dublin? Well, I wouldn't start from here.
Start from here, exactly.
How would you run a Fed? How would you run a balance sheet? How would you run an inflation framework? Well, I'd do it this way, but I wouldn't start from here because it's been done badly for a very long time. And that's created this inherent fragility. And remember that fragility in go on and on about it. This isn't just a U.S. problem. This is very much a global problem. The Hunger Games analogy, the competition for debt issuance is an everywhere thing. It's not just a U.S. thing.
All right, let's just finish with this real quick and then move on. Do you think, we talked about, funny enough, when I was like running over the bond bears at the end of February, it's been a rough run for old Benny here since then, at least in the front. You think that this is something that, they're going to say, oh, it's temporary, but the squirrel's long energy. And I would say that the big miss that the market didn't realize was just how much inventory China had built up. Well, comes out the math is they burned off about 300 million barrels, and Japan's obviously burned some, and the U.S. So inventories are lower. So you could argue that this has gone the wrong way for them, but we're in a more fragile situation now, and all we see is Trump. It doesn't sound good out of this whole thing, like he was trying to say at the UFC fight that he put out front of the White House. I don't know. What do you think here?
Yeah, I would agree with you from its very simple perspective. We now know with hindsight that the dependence on oil was really resilient because everybody had a whole bunch of reserves. In particular, China had absolutely massive reserves and had the appetite to squelch demand and usage at a phenomenal scale. Now, whether that's they just, it was cutting the refining that they're going to on-sell to somebody else or what, but their usage declined massively, and their, unspecified amount of reserves they've drained was an enormous change.
It wasn't so much their usage; they just cut their imports, right?
Yeah, right.
And effectively sort of, bailed us all out to a certain extent.
Yeah. But that means the system's less resilient now, so it's more fragile to a future shock than it was when China and Japan, two of the largest economies and largest exporters, industrial capacity in the world, were at peak reserves. Now we know Japan is well below peak reserves. We don't know exactly where China is. Yeah, that's a great picture, Biddy. That's goes to my Hearst exponent story that I wrote about a few months ago. Again, talking about inflation, that they've released the accumulated endogenous fragility of this inflationary impulse that they let go when they did FAIT, flexible average inflation targeting, and said we're not going to worry as much about floods as we used to do because we've been through a long period of low rainfall. So we're going to let the reservoir fill up a little bit more. We're going to make up for the past years of low rainfall. But after now 1, 2, 3, 4, 5 years of it filling up, it's a lot more fragile than it was when we started. And so it doesn't take a whole bunch of additional rain to bring the thought of flooding back into everybody's mind, i.e. the price level is a hell of a lot higher than it was 6 years ago. And what you think of, and again, I hate using their numbers because the numbers are really meaningless, but you say, oh, well, it's only 3% inflation. Well, 3% on top of multiple years, the price level adjustment is massive. And people are very sensitive to it, very aware of it. And so they're much quicker to raise prices if your input prices go up, to ask for wage increases. The feedback, the pass through is much quicker. And so when the geniuses in charge say, well, we're waiting to see if we're looking through the initial shock and we're waiting to see if there's any second order effect. Well, that's bullshit. Of course there's second order effect. There's obviously second order effect. You're not going to get away with what you got away with in 2021, where people will sit and listen to you, parrot transitory and looking through for a whole year before the shit hits the fan. People immediately are going to start adjusting. It's already, you guys have businesses. We have a business. Prior to 2021, after so many years of calm, none of our service providers had built-in inflation adjustments for the fees. After 2021, everybody does. Everybody has an automatic kicker for inflation. So of course it's immediately going to ripple through the system. And there's, I show that picture more than any other picture in my writing because that's just the fact. That's the condition where we are. They went along at roughly 2%, that CPI, which is the red dashed line, for a very long time. Now, of course, in the midst of that, those tiny little blips, temporary times before the line, led to zero interest rates, QE, flexible average, throwing everything but the kitchen sink at it to try to offset, any sort of efficiency gains for productivity. Can't allow it. But then they took the lid off with this average inflation targeting, and I wrote that month the beginning of the end, way back in August 2020. And that's just taken the cap off, and now it's very hard to control it because again, everyone should go read the chapter in Mandelbrot's The Misbehavior of Markets, the Hurst exponents on Edward Hurst. Just talks about long memory. It talks about the accumulated memory of time, working on damming the Nile River. It's fantastic.
It's also a big killer of IID. You know what I mean? Which is like one of my real bugaboos is a guy who almost got a PhD in finance and is very happy he didn't. Rupert
and I wouldn't be talking to you today if you'd done that.
Oh, I'd just be a miserable prick.
We'd be talking amongst ourselves.
But let's talk about it for a second, and then I want to dive into a few things where, you have this hope that, okay, your buddy's on the panel, Warsh is saying these new things, but you guys have been around longer than I have, but I always get excited, except for Yellen, your old professor. I never got excited for her, but I did get excited for Powell, and he kind of just did what he did. Maybe he was a little more hawkish, but how do we not get disappointed and think that they actually could shift to, you can talk to sharp world versus real world, and then we'll talk a little about ergodic processes and move on from there.
Yeah, I'm with you, right? So, Jay Powell, a former Bankers Trust colleague of mine as well. So, when he was a governor and prior to getting the job, getting appointed by Trump over Warsh, who was, a competitor at that time, was hawkish, he was anti-QE. He was a critic of all this stuff. But once he gets in the seat, the pressures that, the powers that be crush it. I mean, most famously, obviously, Alan Greenspan. Alan Greenspan wrote books about gold and hard money. Alan Greenspan thought, if we're going to inflation target, stable prices is 0%. Not, it was Yellen who talked him into 2%. And yet, once he got in the chair, man, the pressure of bailing out Wall Street, financial dominance, which was the sort of theme up through the GFC. Now we've added fiscal dominance on top of that, is overwhelming. And so, everybody will say, well, of course they had to bail out the banks. Of course they had to buy the bonds. Of course they had to buy the mortgages. Of course they had to do all these things. Of course you have to prevent fires because you've created so much fire risk by preventing fires that you have no choice but to prevent fires. And the loop goes on and on and on until somebody comes along and stops it. The great comic that I use all the time, what are you doing? I'm fixing the problem that I created when I fix the problem that I created when I fix the problem that I created. Right. So
okay, so let's get a little bit meta then. I mean, it's all very well identifying the issue, right? But is a controlled explosion or a controlled detonation actually possible? I mean, listen, it sounds great to withdraw forward guidance, to increase treasury volatility, but there's an awful, an awful lot that can go wrong with that too.
Yeah, all over the world, there are fragilities. Now we're seeing these fragilities. Now we've been talking about, another thing that Ben and I talked about a lot. It's my deja vu. It just keeps feeling the same over and over again to the late 90s, where the strengthening U.S. asset markets, culminated in the dot-com bubble, and the strong dollar at the time, and the Fed, Greenspan's efforts needing to tighten but not being willing to tighten because every time he tried to tighten, the world blew up, and so you got this kind of constant explosion around the world. Asia crisis and Russia default and LTCM in the midst of 5 years of 28.6% compounded annual growth rate on the S&P. 5 years, right? Every year, up over 20%, up over 30%, and which culminated in the dot-com bubble. And in the midst of all that, so, my deja vu, and, as you guys know what we do for our business here, is people running assets and then using us with a multi-asset convexity long vol sleeve to create negative correlating asymmetry while they can participate in risk. Well, obviously that's been a pretty good strategy, for the last 7-8 years, because those assets have just gone up, up, up. And there's been, every year there seems like there's something, right? We had Epic Fury this year and Liberation Day last year and yen carry unwind the year before. And of course, 2022's rate hiking cycle and COVID in 2020. There's all this stuff going on. But meanwhile, the stock market in particular, this picture here has got, S&P on it, it just goes, it just rips. And so this, our premise of owning the wings, of owning convexity in both sides, where the investors are allowed to take, are capable of taking much more participating risk because they have much more efficient, explicit risk mitigation. They're not sitting on bonds and faux diversifying strategies and flawed methodologies like risk parity. They this year, in fact, I don't know if I've even told you this, Benny, in one of our hypothetical strategies that we tongue in cheek call always good weather, it's making fun of the other name. The best 2 months, the best 1 month and best 2 months ever in our track are April and May this year. And so you cut off the downside with the convexity in March, and then the participating assets have their best months ever back to back in April and May. And
maybe we could talk about that a little. Let's talk about that a little bit, because I know that's a newer area for you, participating in single stock vol. I mean, the single stock vol to index vol dynamic has gotten to extremes, right? And, you're making money on it. There's a lot of hedge funds making money on it. And, even like when you look at Micron, like there's down days on Micron features down vol, right? Yeah. So there's a dynamic here where long index vol, short this stuff might be starting to be the convex trade, in the sense that like you could get paid both sides of that. It's a crowded trade. And as we know, as Dave, you like to say, positioning and leverage is what matters. Well, this is both, right?
Yeah. Yeah. It's something sort of Ben knows a little bit, we're in the business of helping people recycle vol supply. That's what we do. And so when vol supply builds up through the various proliferations of structured product activity, hopefully some of it finds its way to us. And so when that gets extreme, the more extreme it is, the more likely it is to find its way to us. So in 2020, 2021, that was interest rate vol, right? The whole system was just flooding with these callable note structures and embedded Bermudan swaptions, and that inevitably became the thing. Now, what's happened in, Ben and I've talked about this over the years, the equity structured product business out here and then expanding globally shifted from predominantly index structures to predominantly single name structures. And that sort of hit critical level in late 2023, early 2024. And so it got to our radar then, and that then continued. So if you go and look at I should have sent you a picture, Benny. If you go and look at the VIX versus the VIX EQ, the VIX EQ is the average vol of the
equal weight
component.
Yeah.
Right. You can look that those things kind of track along together until end of 2023, and then they start to separate. And that separation has just continued and continued and continued. Now, obviously, there's noise in there because we have Liberation Day and we have Epic Fury and you have peaks and troughs of it. And then eventually, by late summer last year, a year ago, it got to levels where now it made sense, levels and structures where it made sense for us to participate. So we started participating late last year from the long side only, in our case, of course. And that's just indicative, again, that a lot of leverage in the form of vol selling, implicit leverage, has built up. Now, I'll argue, and it's so complicated, right down at the kernel, but I'll argue that proliferation of vol supply, which has been extraordinary in scale, nobody can understand the scale of this, is what has caused now this divergence, because the management of the complexity of the second, third, fourth order derivative effects of these exotic auto-callable structures on the single names makes it far more complicated than managing the index leg of all the different people participating, whether it's on the dispersion trade themselves or just the general markets participation in VIX and S&P vol. And so as it pulls apart, it has a tendency to pull more apart. And in a sense, it's literally forcing the implied correlation down. Just the actual active management of this complexity, of in particular some of the things like Vanna and Volga that are prevalent in these auto-callable structures that have knock-in puts and knockout calls. Now, what you've obviously seen, Benny, and what you're talking about, this sort of spot up, spot down, vol down, is because as these names have run up, they're constantly knocking out the structure. And the guy collects his coupon, which they see, you got a 2% coupon. You say, well, that's 8% annual return for a quarter. So that's an 8% annual return on an equity that you've just foregone 50% up move. And they say, oh, I made money. They didn't make money, but and so they keep losing the vol to the top side as things go up. As things come back down again, they're the other way around on their Vanna, and they actually get longer vol as markets fall until it gets to the knock-in put strike, which as vols are high enough, that it allows them to push that put strike lower and lower to get the target sort of enhanced yield. And so there is somewhere down below a potential blowout. But what we have seen and what we continue to see is the market losing vol, the dealers losing vol as these names go up. Now, obviously, that's been most prevalent in the crazy place we call Korea, which is like its own other level of chaos, which again, the regulators, I assume you saw yesterday, boys, the regulators announced they're going to try to clamp down on a little bit of the leverage going into some of the Korean single.
A bit late, fellas. A bit late, fellas. But talk to me a little bit about how the dealers are managing these levered ETFs. 7709 in Hong Kong and the various others. So, and how's that finding its way to you?
Yeah, that doesn't find its way to us because that's done, right? That's well, we're in the business of buying volatility, so nobody's selling volatility on those names because the guys managing those ETFs, and most particularly the guys who are the swap providers to them. Yeah,
so that was there's been a lot of chatter around swap capacity on the broker-dealer balance sheets right now, and I really wanted to get your take on where that is.
Yeah, we're observers. We're not participants. I used to would have participated in this sort of markets in my investment banking days.
Very bankers trust behavior. Very bankers trust behavior.
We may have been early innovators in exactly these types of things.
You invented every brush fire there is in financial markets over there.
Obviously these levered ETFs. So in particular, the 7709, the Hong Kong listed 2 times levered on SK Hynix, the big Korean chip manufacturer that has just been explosive. It's not 2 times leverage over the year's performance, it's 2 times leverage over the days, but just one day. And so the managers of these ETFs need to rebalance constantly throughout the day as the thing goes up and down, trying to create that 2x leverage. Now, the way they tend to do that is they do a swap to get the leverage from a swap provider, which will be the usual cast of usual suspects. Our former employers, Goldman Sachs and JP Morgan and Citibank and the likes. Now, both the manager of the ETF and the swap providers, as things have gotten particularly difficult and crazy, have jumped into the option markets. And so they've been buying options. Now, I won't go into all the complexities, but in general, buying in the money calls, the equivalent of a delta hedged out of the money put, to try to create some convexity to keep up with this chaos, because these things are going plus and minus 10% multiple times in a day. I mean, it is nuts. And so you've got both the ETF manager and their swap providers actively bidding for vol. So, if you want to sell 1 day to 1 week vol on Hynix at 160, 180 vol, there's a bid. I guarantee it. And because the swap providers and the ETF manager are trying to accumulate this vol to manage this risk. And then, of course, you have everybody who's well aware of the rebalancing demands of this activity. Smart people, I know you may have heard people like Citadel or Jane Street, or like maybe Bankers Trust back in the day, even Goldman Sachs, who was one of the swap providers, maybe, front running all the rebalancing, trying to stay, anticipating what the rebalancing is going to be and front running it in both the option and the spot market. And so this just creates absolute utter chaos. I mean, the money that's being printed in the market making dynamics around all this stuff in Korea is off the charts, and it goes and goes. In fact, I'm now aware that some of the swap providers who are very active in provision of swap option management of their risk in the provision of swap, front running their own rebalancing needs, are now providing QIS products to clients to participate in the front running. So you can go and get a QIS from a swap provider to participate in the front running of their own desk.
Yeah, well, we all saw the equity trading income in the latest quarter for Morgan Stanley and Goldman. I mean, it's clearly phenomenal business while it works.
Yeah.
And it's nuts. I mean, so it's a shame for us. I mean, we would have been active in Korea stuff 2 years ago. And all that stuff's been monetized a long time ago, and looking for something else that is cheap. There's nothing cheap in Korea right now for us.
Dave, real quick while we're on Korea, before we go to the beach ball, just kind of put this Korean market, which I think for a lot of Americans who probably before this never paid attention or even had heard of the Kospi. Now it's, Rupert sent me a picture of a girl walking down the street in Hong Kong with an SK Hynix jean jacket. So the world's become quite aware of the Kospi, and put this in reference to Taiwan and Japan, late 80s, the .com, give us a little, because you're the elder Yoda around here. Give us your perspective.
Yeah, it's this is a classic, right? People will say, people assume. I had the great pleasure. I don't know if you know this, Squirrel. I did a little stint in Korea in 1991 on loan, essentially, to the Ministry of Finance, helping them draft the rules, regulations, and pipes and plumbing for foreigners to buy stocks in Korea, which they were first opening the market to foreigners. But prior to that, everybody's familiar, I think, with what's known as the Nikkei bubble. There was quite a decent bubble in the Nikkei in Japan in the late 80s. that bubble, so I'm going to do this from memory. Japan, from 85 to the end of 89, beginning of 90, the Nikkei went up 6x. In that same window, the Kospi would have gone up 12x, and the TWSE went up 25x. So people are
basically Korea is silver to Japan's gold.
Yeah, and Taiwan's helium, is like it's platinum.
It's the levered little brother.
TWSE went up 25x, while everybody was worried about the Nikkei going up 6x, and then TWSE came down 80% in 1990. In 1 year, down 80%. And those were proper bubbles. But my main story around that is the Korea bubble, which was twice as big in the late 80s relative to the Japan bubble, was domestic only. It was still closed to foreigners. They managed to do that. And all three of those bubbles were, in essence, the same thing. It was all the cross ownership, right? So it was the Keiretsu and Zaibatsu in Japan, and the Chaebols in Korea, and all the KMT party-owned quasi-sovereign entity-owned enterprises in Taiwan, and then the advent of fund management and pension funds, all controlled by the same people, putting the money into driving up their own stocks and massive. I mean, this all sounds so familiar to recent things, tiny floats. So they were constantly IPOing these affiliated companies where they, the Chable owned 95%, they floated 5%, and then the Chable's own pension fund controlled by the Chable would buy the 5% up 100 times. And they'd say, well, look how rich we are now. And they'd go and borrow money from the banks to do other things. So, the point being, when people say, you've never seen anything this crazy before, referring to current cost speed, I'm like, oh yeah, I've seen crazier than this. This is nothing. This was much crazier back in the late 80s. So my point being is, people say, well, it can't get more crazy than this. I'm like, well, maybe it can. It comes back to the same old thing. Leverage. If the authorities will turn a blind eye and allow the leverage of 2 times levered ETFs to proliferate, it could keep going, right? They could just keep pushing it in. So, but I also say, anybody who asks me, what do we do about this? A lot of people say, what can we do about this? Generally because they haven't owned it, right? So they've missed it, and now they're feeling the pressure. And so now they're trying to jump in to tech and AI and chips, and now they want to hedge. And I'm like, you can't get a hedge now. You could have gotten a hedge 2-3 years ago and then participated, but now they want in. And I said, the answer now is it's too volatile, right? Just like if you were running, you boys will be familiar, you're running a trend following model, and you're running a trend that, you've been riding, you've absolutely won the lottery. But when it hits this level of volatility, you're de-risking it massively. You have no choice, because it's no longer rational to participate in any sort of reasonable size.
And so that brings us to one of our favorite topics, the beach ball. So David and I chat a lot. And one day I remember a couple years ago, I was like, I think we should just call the yen the beach ball. And then, because he is the Yoda, he's like, I actually wrote about that. And he cites real quick his link. He's like, here, you're going to read about it. So let's talk to people why we refer to the yen as the beach ball, and then let's get into Japan. I know the squirrel wants to talk about Japan, so let's open it up.
Yeah, I wrote early 2022. The still then ongoing YCC in Japan on the 10-year JGB, was the most dangerous peg in the world, and that obviously was doomed to breaking. And when that broke, you were going to get this run in interest rates, and the resistance of that, the ongoing resistance to letting it adjust, the feed through mechanism is the currency. And now we've seen the currency run. I think when I had that first conversation on exactly this topic with the Bank of Japan, was dollar yen was 105 or 110 or something. Just kept saying, can you not see this? And now I'm to the point where, when I talk to them, I've accepted that it wasn't that they didn't see it, it was that they wanted it. They wanted to destroy the yen. And I think most of them are a little bit shocked that it was as effective as it was. They didn't think it would work this well. Now they're at the point where they're still committed to their policy, but only comfortable doing it on a belief that the Ministry of Finance will control it by intervening in the yen, because it's gone too far. But they're not changing their mind. They're still going to stick with this debasement policy of far too low interest rates, and a constant fabrication of what their inflation measures are, and rely on the intervention capacity and the constant verbal threats from the Ministry of Finance, who have now told us that they're no longer going to warn us before they intervene, because the warnings used to scare the market, then they stopped scaring the market. So they said, well, we'll stop doing that, but we're always ready to go. Okay, but if the Bank of Japan, the only way to provide stability in the yen, and in my opinion, stability in the JGB yields, is for the Bank of Japan to normalize interest rates. They need to flatten the curve, and that's going to have to happen at some point. Now, so you guys know I've said it forever. I'm not a predictor of what's going to happen, but if you held a gun to my head about what's the likely trigger for some sort of global correlation event, it's Japan. It's got to be Japan. They're the biggest, most important, only guy on their side of the Hunger Games competition. They're the last guys providing liquidity into the system, not taking it. And so we saw.
So what was your take on Katayama's statement around the GPF allocation on Friday?
I wrote about it in the note, noting the Germans making a comment, the English making a comment, the Japan. It's all part of the Hunger Games. Eventually, they're going to have to force that money home. Everybody's going to say, we have to buy our bonds first. You have to buy our equity markets first. You have to fund our infrastructure wishes and desires, our military.
It's precisely what I'm writing about the UK this weekend through that prism.
And it's disappointing because Andy Halday is a big hero of mine. His supervisory note, The Dog and the Frisbee, is the best speech ever written on complex systems. And yet now he's aligning to saying, well, we're in the Hunger Games, so we're not going to talk about complex systems and non-ergodic complexities. We're going to just do what we have to do, which is to suggest pension funds have to buy UK assets. And so it's inevitable that Japan's
all roads lead to financial repression of some kind, right? Ultimately, where does that leave District 1, the capital as you call it, right? As the biggest sort of net borrower on the planet.
Well, I think this comes back to a little bit what we were talking about. There's great Hunger Games, the circular route. So I've expanded it to the Hunger Games and resource wars, right? So you think back to pre-COVID when we were at sort of peak QE by everybody, and insurance companies, pension funds, the regulatory construct and sharp world accounting rules incentivizing them to maximize duration, maximize leverage, high duration and leverage. They could do their callable note structures and not put the levered duration on their books. They could account for them as the duration of the call date. You were at sort of peak all of this stuff, and raising money and buying oil and rare earth minerals was a piece of cake. And then it's flipped, and now it's hard to sell bonds. Everybody is your competitor. So thus, you immediately move into a world of friction, right? Because the guy who was your friend, because you weren't competing to issue your bonds, is now your competitor. You want your pension funds to own your bonds, not his bonds. You want your banks to own your bonds, not his bonds. And you're now also obviously a competitor in these resource stacking, to rebuild out your tech stack, because all of a sudden the tech proliferation is a critical for your security state. You got to build out your military. NATO all has to meet their spending, right? And you need resources for that. You need resources for tech. You need rare earth minerals, which is obviously China's biggest bargaining chip in this. You need oil. You need copper. You need silver. You need helium. And so now we're in this sort of proliferation of this spiral of bond issuance.
And that's all so inflationary as well.
Yeah,
right.
I agree. And again, all driven again back to the demographics issue, right? The fact that every one of these countries that you can think of is in this unprecedented decline in working age population. So the very people who pay the taxes and provide the savings to own the bonds are shrinking in mass. And the replacement level's not there, getting worse, not better. It turns out it's not as linear as we thought. And this is creating this competition that I just don't see how you stop the spiral. But to your point, the U.S., who is the biggest debtor, is also the most powerful. All right, they're the dollar, the reserve currency status of the dollar, which I believe Mr. Bessent and Mr. Warsh are tasked with using to their benefit in this competition, makes it an almost insurmountable competitor, because whatever problems that they have, the rest of the world has worst first, right? Because if the US bonds are getting sold, so are the French bonds, even more so. If Japan is pulling money out of treasuries and it's impacting the treasury market, Japan pulling money out of Chinese government bonds is an even bigger problem. Japan pulling money out of gilts is an even bigger problem. And the U.S., maybe over levered in its capacity, has the best tech stack, has the best military, is ahead of everybody else in that part of the race, has natural resources. And so, they're a big competitor. When I coined this analogy, the Hunger Games, I made then Treasury Secretary Professor Yellen Katniss, and and Jerome Powell, her partner, PETA. But I'd have a hard time calling Scott Bessent Katniss, but I'll have to come up with some new analogy.
Oh, I could get away with that.
I guess you could. Yeah, I guess you could. So, yeah, I just think that this is what undergirds everything. You can explain everything by this, and to exactly your point, Rupert, and this is, an argument that I have with Bill White and other friends, Russell Napier, who say, well, financial repression is the only solution. I'm like, no, financial repression is what got us here. Financial repression worked just fine in the 50s when the baby boomer population, pig in the python, was just barely in the jaws of the python. And all of that population's future taxability, tax paying, and savings was in the future. But now that's in the past. And they're not paying taxes. They're retiring, they're dissaving. And the population cohorts behind them, and not just in the US, but throughout Europe and Japan and North Asia and China, are shrinking at pace. And you're now having to subsidize the retirement costs because you've debased their savings through forcing people to save in bonds that didn't keep up with the cost of living. And you got fewer taxpayers to cover it.
There's no free lunch, right? Like once you cross that Rubicon, and I got a slide, one of your slides on here, of 100% debt to GDP, you're just throwing more money at the same amount of goods and services, right? And so it's not really magical how, like, if you compare it to like a circuit system, there's no more capacitance in the circuit. Now it's all inductance, right? And then eventually the field fails. Like, and that's kind of, we're going to see that in a large scale. And if you look, this is Dave's slide, just showing that, sorry, I should have made the things a little bigger, but that line, that 100% line, there's just every year there's more people crossing the Rubicon, if you will, right?
Yeah, this comes from a great paper. Everybody should go and into my note and click on this paper by Hanno Lustig, who's doing some great work. And he's written a paper, they've done a whole paper, and he's written a nice Substack note explaining it, that is in effect my rational accounting map, right? It's exactly my argument about the bond markets becoming completely detached from price sensitive participants. That at the peak of bond prices, the bottom of yields, virtually the entirety of the participants in the market were rational accounting men. They were non-price sensitive participants. They were QE acting central banks. They were global FX reserve managers just mechanically buying treasuries as they were intervening in their currency on the other side of the QE that was flooding liquidity in the system. They were banks with zero risk-weighted asset and hold to maturities. They were pension funds with IAS 19, liability-driven investment, risk parity accounting constructs that said owning levered bonds is risk reducing, so own more. Even though they yield zero, you can lever them and reduce your risk, right? They are insurance companies, and their treatment of duration, the Solvency II, saying that long duration risk is less capital than cash, and less capital required than holding cash. And adding duration again is reducing risk, and the accounting that allowed particularly Taiwanese insurance companies to mask all the hidden duration of these callable note structures and not mark to market. They're sitting on massive unrealized losses. And of course, Japan takes that to the ultimate extreme, where our estimates would say at the peak, roughly 95% of the market in JGBs was what Mike Green would call passive, right? They were not price sensitive. They were just buying mechanically, heedless of the price. And the fact that at a certain point, it was 100%, 105%, because the Bank of Japan was buying more than the amount of bonds of certain issues, right? They were more than 100% of the market was passive, if you think about it. And that to me is the mother of all bubbles. And I think this is something that people miss, even our great friends who are far better experts on passive than we are. who focus so heavily on equity markets miss that the exact same argument applied to bond markets tells you that in late 2020, we hit a bond market bubble of epic proportion, and a particularly complicated one because of at least the passive investment in equity flow. Somebody's using their capital to mechanically invest so they can lose that capital. But in these bond markets we're talking about, it's all fiduciaries using, if at all, somebody else's capital. But in the case of banks, no capital, right? Those zero risk-weighted assets don't require any capital. It's all just subsidized.
Yeah. And Dave, real quick, I forgot to follow up with this about Japan. Can we walk through this idea of, and I've talked about it here before, of, okay, the curve is steepened quite a bit, and you talk to the BOJ. What is it going to take to get? Is it going to be the beach ball at 175, or what is it going to take to get that for them to take policy rates to real rates, and what is the implications of that for broad markets? Since what the squirrel calls Japan as the Saudi Arabia of global savings.
That's a good one. Yeah, I don't know. I mean, I think dollar yen breaks higher. The Ministry of Finance, I suspect, has some concern about the efficacy of their intervention, as every time they do it, we just end up back in the same place in a number of days. I think, the last round they did $80-90 billion, and it had an impact for about 4 days. That seems like a big number to me, but so
is it a real number though, Dave? If you think about it, Benny and I were talking about this on the Sunday show. I mean, yeah, it's a huge absolute number, but is it a real number given the if you like, the built up gains on foreign FX reserves that they've established over the years? It's funny money compared to that.
Yeah, well, it's to them it's not a big amount, but you think in the market it's pretty chunky. But of course, as you can see when it happens, they're sloppy, right? They come in and make a lot of noise, so of course everyone just pulls their bids. Right? There's no reason to stand there when they're jumping up and down and screaming, "Look at us! Look at us! Look what we're doing!" And so it drops 5 big figures, and then they stop, and then all the bids come back in again. So I'm not sure it has any real effect. I mean, it's always, intervention's never going to work until you catch the market out, until the market's wrong-footed. And so everybody's anticipating the intervention, so it's not really a surprise. I've told Benny the story from back in '95 when Bank of Japan was trying to defend 100 on the bid when they were accumulating all these dollars. We just laughed at them every day. It just kept hitting the bid day after day after day, and getting Bank of Japan as a name, which we had to switch to some bank that Bank of Japan didn't have lines for Bankers Trust, so some Japanese bank would switch, and then at 79.80 one day. So we'd broken 100 and we drove it all the way through 80 in a matter of days. And it was Bank of Japan on the bid all day, every day. At 79.80, we hit the bid and said to the broker, come back to us with a name. And they said, "Oh no, this guy's got a line for you. It's the Federal Reserve Bank of New York." And that was the end of, and it's like, buy them all back. And that was that. So my point being, maybe Mr. Bessent's going to have to get involved if this is going to work. But the point is, it's not going to work if Bank of Japan is going to continue to cause the problem. So until you fix Bank of Japan, intervention is just temporary fix. So I do think that this will go at some point. They'll let it drift, as happening as we sit here and chat. And the pressure on Bank of Japan will build, and the resistance from the Takaichi government to Bank of Japan normalizing will weaken, because I'll argue she has her job because the past ruling coalition broke because people are sick of the debasement of their currency, of their purchasing power. And she came in and they thought that she was going to do something about it because she talked hard about immigration and some of the taxing tourists and some of the thing that's a downstream effect of the currency being too weak. But she's not really done anything about it. And she had this plan that she announced last week, maybe, but Bank of Japan's the only one that's going to fix it. So yes, if you made me tell a story about what I think happens, I think dollar yen goes higher at some point, and then Bank of Japan becomes more active in rate hiking and maybe does a little forward guidance. As much as I dislike it, says, we're gonna proceed to normal. I mean, I've been saying to this
taking over the baton on forward guidance. It goes to
Well,
Tokyo.
You saw Bank of Korea did it yesterday. So Bank of Korea hiked yesterday, and all the way to 2.75. I mean, you look at their stock market has done in the last year, and that their policy rate is 2.75. They've lost the plot, right? But he did say, and we're going to keep going. We're going to keep going, which I think.
But it's still such a cheap market. Don't forget that, Dave. Still such a cheap market. Just back to Takaichi, right? I mean, and her announcements, her big public-private partnerships, and her big fiscal plan. To what extent do you think that gets derailed by normalized yield curves? I mean, can it still work? I mean, there's plenty, as I keep on saying, there's plenty of capital around to make it work.
I think she's okay, right? I think things are going so well there that their fiscal deficit has declined, significantly declined, and they're in a way better place than most of the other competitors. So I think the tax proceeds of the boom that's going on in Japan is giving her more runway than otherwise you would have thought she would have. Now, she still needs to stay prudent. I mean, the solution to everybody's problem is you got to slow down the pace of bond issuance. That's how you win the Hunger Games, is you stop competing as best you can. And she's in a good place to do that, should she choose to. And then Japan has the obvious mega benefit in the Hunger Games competition in that the private sector is not indebted. So households and corporations are not indebted. So they can take over the borrowing and investment side away from the government, which is exactly, the reverse of what happened after the 80s bubble, where the private sector delevered for decades and all the leverage moved onto the government balance sheet. Now you need to move it back again. And so I think Japan can get away with it, but I do think it has implications for the rest of the world, because that means the private sector in Japan investing in Japan and not investing in the rest of the world, and that money recycling back. So I do think it's a major trigger point when we get there.
I think Japanese risk assets are a major hedge for anyone against the Hunger Games unwind, right? Yes. Long Japanese stocks. Yeah. Not sure I'm ready to be long Japanese bonds, but I think,
I mean, there could be a point though, right? Like, I mean, if you were to think of this through, and maybe we'll finish with AI in a second, the Polanyi paradox, Dave, but like, it's all kind of one big trade right now, right? Like, financials doing well, like you said, the trading's ridiculous. I'm sure Korean financials are crushing. The idea that you'd have the yen get bid, so dollar yen down, and then these other Asian currencies get hit, probably is related to it. Dave, the squirrel had highlighted last Sunday about how there's this huge ADR versus local premium going on in Taiwan Semi and SK. I mean, I think SK Hynix got to 50% yesterday, right?
Yeah.
Something like that. Well, it's unwound a lot since the weekend. I mean, and actually, interestingly, TSMC's ADR premium has come dramatically in the last few weeks, right?
Yeah.
I think the same thing happens with Hynix, even though the two-way fungibility isn't fixed until the end of the month, and even then not completely fixed. But anyone can buy the local Korean won stock if they want to via interactive brokers. So, the ADR premium is a representation of hot air.
Yeah, exactly.
It may not be perfectly arbitrageable, but logic dictates that a rational person would not buy the ADR unless there was a mania, right?
Yeah. Exactly. All right, let's finish with AI since it's 2026. Dave, you wrote about this a while ago, Polanyi paradox. Maybe you can tell people. And, I told you last week I went pretty deep into the AI framework, and I was like, oh, there's a whole non-ergodic piece to this that's a hidden cost, just like in finance is a hidden cost. So maybe talk to it, what the Polanyi paradox is, and kind of your thoughts, maybe from the convex angle about AI.
Yeah, particularly LLMs, I see a lot of parallels with Sharp World. They're probability distributions, and they optimize to the mean. You get the average, right? And you get an average based upon historical outcomes. So they're not actual probabilities. They're just historical frequencies on things that may or may not be normally distributed, well, which we actually know generally are not normally distributed. And so the Polanyi paradox, very famous philosopher, mathematician, Michael Polanyi, came up with the Polanyi paradox. Well, actually, David Autor, another famous economist, named it after him. That is, we humans know more than we can tell. We have what Polanyi terms tacit knowledge. We know how to ride a bike, but I couldn't write down the physics formula and explain it to you how it works, but we know it. Well, LLMs, I coined the reverse Polanyi paradox. LLMs can tell more than they can know. They can tell you anything. They'll provide a rational answer to every question. They actually know nothing, right? Because they're just putting the most likely word after the previous most likely word and giving you the average of their data set of knowledge. And again, this is Sharp World. This is modern portfolio theory, efficient market hypothesis. Everything optimized to a historical frequency. But when in non-ergodic paths, it's not frequency that matters, it's magnitude that matters, right? It's the thing that matters the most, not the thing that happens the most. My football pitch, it's what happens in the penalty boxes, not what happens in the middle of the pitch, right? You can, no matter how many times you pass the ball in the middle of the pitch, it won't make any difference. If one team prevents goals and scores goals.
Funnily enough, if you do in England and spend the entire second half defending your penalty box, things go really badly for you.
It's nonsense, right? And this is exactly, that we're going to come out with a white paper. We've been collecting all the data, and we're going to come out with a white paper on the World Cup. But here's my picture from the Olympic hockey when the U.S. won, where the goalkeeper made 41 saves, kept him in the game so that Jack Hughes could score 1 goal in extra time. That's how you win the game. And if you go and look, and after the game, the Canadians were all crying. We dominated. Look at the possession of the puck. We made more passes than they did. Well, that's not the objective of the game. The objective of the game is have a goalkeeper that gives you the ability to attack. And this is where I will argue England, and our paper will show it. England screwed up. The reason you play good defense is so you can attack. The reason you own good protection on your investment portfolio is so you can aggressively pursue opportunities. You don't.
I'm going to disagree. I'm going to disagree with you without disagreeing with your finance analog, right? I mean, I think what went wrong is that yesterday is that they got 1 goal ahead, and then relied on defense completely and removed the risk of something happening at the other end.
That's exactly what I'm saying, right? That's exactly what I'm saying. The point of having defense is so that you can attack, and they decided to only play defense.
Yeah,
that's not the point of defense.
Yeah, and this slide kind of shows it, right? Like the right tail matters, right? Your famous chart that shows 2% of the observations on the right and 2% on the left are what dictates the outcomes. Both tails matter.
Right. As I said last time, I'm never going into a meeting with a pension fund, a sovereign wealth fund, telling them the world's coming to the end, you better buy protection. I'm going into every meeting saying, why are you driving so slowly? Right? Why aren't you being more aggressive? Why aren't you attacking? Why do you have all of your players concentrated in the middle of the pitch, running around passing the ball? And the answer always the answer is because we don't have breaks. We don't have a good goalkeeper. So we're just trying to control the ball. We're just trying to park the bus. No. Put brakes on the car, drive fast, drive aggressive, try to score goals. But do that because you've got the best goalkeeper in the tournament. And I think, obviously we don't predict, but if you run our model, it makes a pretty good case that Spain's been the best team in the tournament for exactly that reason, right? They've had the best combination of strong defense and efficient attacking. And they have dominated. And the way they dominated France was impressive because France, I thought, was a good team.
Well, I can't wait for the paper. When's it out?
As soon as the final is done and the stats. So that there's a site that provides like unbelievable data on every game, all kinds of, detailed information. So
momentum and possession and stuff like that.
Yeah. So we draw all that, and then we put it into our convexity layer model. And so there's sort of 3 layers of convexity: defensive convexity, offensive convexity, and individual player convexity. Because there is an element, just like in your investment portfolio, it's, you can win by having a good goalkeeper, good protection, and being in the index where you're always in there, and the best players are growing in weighting in the index. It's like a momentum trading index. But there's an element of, geez, if I could find that one guy, if I could find the next Elon Musk and get in before anyone else has recognized him, there's a certain randomness to that uncapped potential upside where some player does something so extraordinary that it differentiates even beyond the other 2 layers. Think Bellingham's 2 goals, sort of against the run of play, and just an extraordinary individual performance. Obviously, Messi dominates that stat with his uncanny ability to make the right pass at the right time, and make it count when it matters. But the key again to that is not constraining the capacity, is not doing what England did. Don't pull the front line. You need the front line. That's the whole point. You need to accelerate down the racetrack, knowing you've got brakes and you can brake late going into the curve. But if all you're doing is driving slowly, the brakes aren't doing you any good. You're not getting the benefit of the brakes. It's about convexity in both wings. And it's just going to be, hopefully, obviously we're just playing around with this paper, but hopefully it comes out. It looks really cool right now. And it's a great, it's amazing how it aligns to our football pitch numbers and picture. It's remarkable how it aligns to that.
Nothing better than the empirical data matching up with your deductive thesis, right?
Curve fitting works every time. Yeah. Dave, thank you so much for joining us. A second time visitor. Really brilliant to have you. That was fascinating. A quick word on where people can find you. I think Benny mentioned at the beginning.
Yeah, the website is convex-strategies.com. We put the monthlies up there. We'll link the links to podcasts up there. We now have a
Substack.
We have an AI search there, so you can click topics and it'll tell you which of the notes discuss that topic. I'm on Substack. I'm on LinkedIn. I'm on X. But I'm not particularly active, but at least we give everyone a heads up when the notes come out. And, I might occasionally recommend people watch smart shows like Benny and the Squirrel. When you do smart ones, when you do not smart ones, I don't recommend it. But when you do smart ones, I recommend it.
I'm so glad that we haven't been excommunicated.
It was close.
We got close there. We got close.
It was close. And I said this to Benny. I said, the obvious question that, is the question I ask in, like I say, every meeting, that you needed to ask him when he was poo-pooing risk management. The obvious question is, why aren't you taking more risk? If you're so confident, he literally had a slide that, it goes up 10% a year. So why would you pay 2% to protect it? Think about that for a second. If I knew something would go up 10% a year and I could pay 2% to protect it, why wouldn't I be taking a lot more risk?
Yeah, we gotta end it like this, Dave, because I didn't go here, but I think we just got to show the non-ergodic slide just to remind people it's not about the average. It's about the path.
It's the path. Nobody gets the average. Nobody gets the average.
Exactly. Well, thanks, Dave, for coming on. We really appreciate it. It's always fun. We'll get you back here in 6 months, and I'll see where we're at. It seems like there's a chance that we've topped out, but who knows? Maybe we'll be at new highs by then. We'll
keep going, baby. Keep going.
Live another day. All right, Benny and the Squirrel out. Thanks for coming. Thank you, David.
Bye, Dave. Thanks.